Welcome back. I'm still here with Michael Craig, Head of Asset Allocation at TD Asset Management, and Scott Coburn, Managing Director at TD Asset Management. And, we've talked about the Fed, we've talked about BOC, we had an interesting piece here with Brexit. I mean, trade uncertainties everywhere. But I want to focus this conversation on markets. The headlines always say there's a disconnect. They're like, recession, inverted yield curve. Meanwhile, all-time high, and we kind of keep seeing these things. So what is your take on the markets? And I'm going to start with you.
So first off, we've been in a 22-month consolidation, so we're not really that much farther away than we were in January 2018.
Can you, just for our viewers, you say 22-month consolidation,
so
meaning?
The market's been volatile, but it really hasn't done a whole lot. There's been a big sell-off in Q4 last year. This year has been a great year, but we basically just unwound. There's a chart right there, you can see it. Hasn't really been that, there hasn't been a huge rally, it's not excess. Today, I think, both in the Bank of Canada, U.S. Fed have given you the green light, and Powell actually said, inflation is nowhere near target, we're not hiking. To me, that is the green flag to buy risk. As our senior wealth asset allocation committee has been overweight equities for most of this year. I think we had a bit of a period where a bit of a lull, a lot of fear mongering, but now with, we're likely going to get a trade deal next few weeks. Brexit looks a bit better. The bond market's supportive. Money is cheap. The stock market's likely to have a pretty strong run here.
Let's talk about the bond market then. So is that what the bond market is saying?
Absolutely. I mean, both the Bank of Canada and the Fed are not worried about inflation. And so to that extent, it's very supportive. We've had tons of stimulus globally. Through the course of this year, yes, the Bank of Canada has been on hold, but broadly speaking, the whole central bank group have been supportive of the market. So right now you've got, stable long-term yields. They'll stay that way. There's no fear of inflation breaking out, and that'll be very supportive for the equity market for sure. All right,
be your own devil's advocate now. So what could change that outlook?
We need idiosyncratic shocks, real breakdown in Sino-American relations. Certainly there's a kind of geopolitical risk always. I think the market is starting to sniff out. We'll have a really important data coming out on Friday with purchasing manager indices, which is a really good kind of real-time gauge of what the market's thinking.
And tell me why that's interesting. I mean, you said
they've been going lower now for quite a while.
Yeah.
It feels like they're starting to base. What's interesting is Caterpillar came out this last week with poor earnings. Stock sold off, finished the day unchanged. So the market's starting to tell you that the bad news is priced in, and it's starting to sniff for inflection in PMIs. PMIs tend to lean to earnings, so the next batch of earnings are probably going to be mediocre for Q4, and then next year we'll start to reaccelerate. So we're, in many ways, not unlike 2016 when we had this mid-cycle slowdown. Oil went to $22.
The Fed cut.
And it's pretty much Groundhog Day. We're here again, Fed cut. Money is, stimulus is here. You're starting to see the deterioration in economic data slow down. It's all about the rate of change.
That's the delta, right? It's not getting any worse.
Got it.
And so while the press will say, things are awful, blah, 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 that's when you want to buy.
Yeah. I mean, is there anything, and I don't want to spend a lot of time on the inverted yield curve because we've talked about this before, and I think it's a somewhat arcane, and to your, why is it not reflective in 30 seconds of what you believe is actually happening?
Guess what? It's positive now in the U.S., right? The 3-month versus 10-year, which is what I focus on, is now positive. So we had 4.5 months. But we've had some central bank stimulus, and yes, to Mike's point earlier, there's distortions. Broad economic indicators are stabilizing. They're not deteriorating at the same rate, and we're looking at the basing here. So, I think we're moving on from that indicator as the sole sort of stress in the market, and then tailwinds from possible deal on China and the Brexit.
Yeah, three things I worry about.
Yep.
Inflation, non-existent. Excessive central bank tightness, they're going the other way. And the third is exuberant stock market valuations going sky high.
But it seems pretty exuberant right now, isn't it?
No. If you look at PE ratios or what have you, if you look at valuations, we're fair.
Yeah?
Not too hot, not too cold. There are some parts of the market that are a bit frothy, mostly in the defensives actually, like utilities, real estate stocks are a bit rich, but cyclicals are very cheap.
Yeah.
And relative to fixed income, right? The premium, the equity risk premium, and dividend yields relative to bonds. I mean, that all is supportive for.
Yeah.
So Scott's being a bond guy. So let me.
Yeah.
So when you look at if you buy a stock for $100, it earns $10. You get a 10% earnings yield.
Yep.
Loosely speaking, the bond market's giving you 1.5.
Right.
And so right now there's a huge premium in earnings yield over stock price yield.
Which is also attracts to the equity market.
The thing with bond guys is they're too smart. No one knows what they're saying.
Equity risk premium, yeah.
Let me ask, I've only got about 30 seconds here, but just in terms of alternatives too, I know there's been lots of money flowing out of public markets into private markets right now. So how about that space right now?
Well, certainly with the recent acquisition with Greystone, we're really bullish on this part of the market. From an asset allocator, it's a new asset class to use. Phenomenal place because you've got positive returns and you have an uncorrelated asset class. So when you think about portfolio construction, it adds a whole new element that's we're quite excited about.